In this video, I want to walk through a question that I saw on Reddit. This was from 2 years ago, but walking through this will help you become a better credit spreads trader as you think about what should I do if the worst case happens, and what if one of my stocks or contracts are assigned, what exactly do I do? So I'm going to walk you through this question and how you should handle it. Okay, so first off, let's read the question. Put credit spreads help, please. Can someone help me understand what's going on with my put credit spread? I bought 6 at 385 and sold 6 at 390. The contracts expire on 11/26. Beginning stock price was 272. Current price is 305. Two of the contracts were assigned last night, and I was wondering what this means for me. What are my options for the two that were assigned? I'm trading on Robinhood, and it looks like the other leg is pending exercise, but I didn't place this order. Also, what should I do with the remaining 4 contracts if I expect the stock price to continue rising on Friday? Thanks in advance. All right, let's walk through what is happening here. So step 1, let's look at the stock price. So we're starting off at 272. So this is, well, that's not the best stop, but 272 is where we're starting. Stock does some stuff, whatever. We're now trading at 305. Okay, so the stock has gone up a bit. Now let's talk about where is our put credit spread. All right, well, sold at 390. Okay, so we sold at 390. So let's see here. We sold, it's currently beginning stop price is 299. Sold at 390. So 390 is way up here. And then bought some at 385. All right, so this is the put credit spread. This is the stock's trading price. This is what's going on. All right, cool. So now we're doing this. The contracts were assigned, blah, 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 blah. Now, let's look at this situation right here. We have the stock trading here, and we have the credit spread set up here. All right, so first off, this person must be very new to trading put credit spreads, because let's walk through how this works. A put credit spread is essentially a bet that a stock price will stay above a certain level. It looks like, in the way this is set up, they're setting up a call credit spread where they're wanting the stock to stay below a certain level. Why? The level is here and the stock is trading here. So that means that this put credit spread is by default losing money. Why? Well, because it's never going to go up above this level unless something dramatic happens, right? It's currently trading at 305 and it needs to get above 390 in order for it to make money. So it needs to go from here all the way up to here to make money. Well, more here to make money. And so again, the likelihood of this trade making money is super unlikely. So again, that's probably not going to happen. So first off, the put credit spread was placed way too high. This whole thing, if I can move it, should be placed lower. Let's see if I can do this. Should be placed around here, especially if they took the trade at 272. This, I can move this now, should be placed here. The put credit spread trade should be placed around this level. Whoa, never done this before. Okay, highlight all these. This trade, or this put credit spread, should be placed below the current stock price, thus giving it room to move and to continue higher in order for this trade to make money. However, let's talk about the situation of getting assigned. What should you do if you get assigned? Okay, well, first off, this put credit spread was way above this level, so of course it got assigned, right? That means that they could sell the contracts early or take or assign them early and be able to do what they want. What happens is sell or contracts that you sold are susceptible to being assigned early. Highly unlikely with put credit spreads, more likely with call credit spreads if you're in the money near your dividend or your ex-dividend date, but still likely. So what happens is a sold one is likely to be assigned, which means you have to give them 100 shares. Now what happens here in this situation, why the bought one was showing pending, was because when you get this, when they're both in the money, then they both can be assigned. And so the person who you sold the 390 to decided to claim their options or claim the shares. So you have to give up 100 shares. And then Robinhood thought, well, this option contract is also in the money, so we can claim that. We can assign it ourselves. So we're giving up. So essentially what happened here is because this was assigned, you gave up 100 shares or had to give them 100 shares. So the plus 100 shares, just like that. Now the 385, actually this is put, it's minus 100. Now the 385, what happened is they were trying to get it assigned so that you could then become a positive 100 and thus balance each other out and be 0 and experience the max loss on this instead of having to hold shares, because as a credit spread trader, you don't really want to hold shares. Okay, so that's kind of why Robinhood took that approach with pending exercise, which is what you see here. But what do we do if one of our things gets assigned? Well, simply what we do is we try to sell the other contract as quickly as possible and sell the other shares as quickly as possible. Now, again, you have to remember your risk of assignment when a credit spread contract is out of the money, which means when the stock is above your put credit spread price, is 0%. Why? Or I should say 1%. Because there is a chance they can, but they're going to lose so much money that no one ever does. So if it's out of the money, you are completely safe on early assignment. You're also safe on letting that credit spread expire. If it's in the money, that's when you start to have risk and reasons why you should start taking trades off the table. So anyways, I hope I was able to explain this well. Number one, the biggest point is put credit spreads should be below the stock price. Again, that is hopefully everyone knows that. 2, your risk increases, so risk goes up when you're in the money. So again, when you're in the money, that's when you need to monitor things. Number 3, our last point here that we're going to make sure that you fully understand what's going on with shares and prices and all that stuff. But what you need to do, and like they're saying here, is they expect the stock price to continue to rise. You need to have an edge. You need to have an understanding where you expect the stock to go, have a direction. So again, you can use indicators, you can use price action, you can use whatever, but have a clear direction to make money. You can see here the stock went up and they thought it was going to go up and continue up. They just set up the trade wrong. If you have an idea of where the stock is going and you place a correct credit spread, for instance, put in a bullish market and calls in a bearish market, then you're going to bump up your theoretical win rate, win a lot more, and be able to become a profitable credit spread trader. All right, I hope walking through this kind of helped. I know this trade was a bit all over the place, and this was from 2 years ago, but I did just want to kind of give some context and do some advice for someone who's going through a tricky situation with their credit spreads right now. All right, guys, if you want to learn more, make sure to click the link down below to grab my free credit spreads trading handbook that will walk you through entry requirements, exit requirements, strategies, and so much more, all for free. All right, guys, smash that subscribe button, and I'll see you in the next video.